This video is created by Jagrat Creations. It is on amalgamation of partnership firm. I wish to solve one sum here before you. Observe the sum on the screen. This is the sum which I wish to solve here before you. B and S are partners of S and company sharing profits and losses in the ratio of 3:1. S and T are the partners of T and company sharing profits and losses in the ratio of 2:1. On 31st of October 2017, they decided to amalgamate and form a new firm BST and company where B, S and T would be partners sharing profits and losses in the ratio of 3:2:1. Now the first important point to be noticed by the student that here S is a common partner. S is a partner in S and company and S is a partner in T and company. So S is a common partner in both the firms. Now both the firms amalgamate. Now in the new firm there will be three partners B, S and T. And remember that S is a common partner. That is an important point to be noticed by the students. Their balance sheet was on that date whereas under T and company assets, S and company assets, liability side and capital and liability side. The amalgamated firm took over the business of a new firm. So new firm BST, new firm Messrs. BST and company purchased the business of S and company and T and company. So business of S and company and T and company amalgamated and a new firm came into existence, that is BST and company. The goodwill of S and company was for 60,000 and that of T and company was 50,000. Goodwill account was not to be opened in the books of new firm and the adjustment being recorded through the capital accounts of the partner. So goodwill is required to be adjusted to the capital accounts of the partners after amalgamation of the firm. Building machinery and vehicles are taken over for 50,000, 90,000 and 1 lakh respectively. Provision for doubtful debt is to be carried forward 4,000 in respect of debtors of S and company and 5,000 in respect of debtors of T and company. You are required to compute the adjustments necessary for goodwill. So I am required to explain you the goodwill adjusted to capital account. For that, adjustment entry is required to be explained to you first of all. That is being questioned. Past journal entries in the books of BST company. BST company is a purchaser company. Past necessary journal entries in the books of purchaser. Assuming that the excess and deficit capital, taking this capital as a base with reference to share in profit, is to be transferred to the current account. So in the new firm, this capital is to be taken as base. Capital has to be maintained in the profit sharing ratio. Excess or deficit capital of any partner will be transferred to his current account, but the fixed capital account will be maintained in the ratio of profit sharing. So you are required to write down journal entries, etc. in the books of purchaser. Now for the purpose of explaining in detail, I am going to prepare ledger accounts in the books of vendor S and company. And I am going to explain you the journal entries recorded by S and company. Though not asked, I am going to prepare ledger accounts in the books of T and company. I am also going to explain you journal entries to be recorded in the books of T and company. And in this sum, you are not asked to prepare the ledger accounts and journal entry in the books of S and company and T and company. I am going to explain you because I want to solve the sum in an exhaustive manner. But suppose that if you are not required to prepare the ledger accounts and the journal entries in the books of S and company, even then you are required to prepare one small working note which is necessary, which is inevitable for the purpose of recording entries in the books of purchaser. Similarly, though you may not write the books of accounts, ledger accounts and the journal entries in the books of T and company, you are required to prepare one working note which is necessary for the purpose of recording journal entries in the books of purchasing company. So I am going to prepare that working note also for your understanding. Now let me start. First I will start with goodwill adjustment entry. So this is the balance sheet given to me. This is the details of the sum given to me. Goodwill of S and company was worth 60,000 and that of T and company 50,000. Goodwill account was not to be opened in the books of new firm and the adjustment being recorded through the capital accounts of the partner. Now, which adjustment entry is recorded, that I want to explain. For that purpose, I will raise goodwill notionally in the books of S&N company. I will raise the goodwill that of T&N company notionally. I will write off the goodwill, and the net effect of goodwill raise and write off will be worked out. That is the capital adjustment entry for goodwill. Now let me start. So goodwill of S&N company 60,000 raised. So goodwill account debit. S and T are the partners. So goodwill account will be credited to the capital account of S and T in the ratio of 3:1. So 60,000 debit. This capital account debit, S capital account credit. B and S capital account is credited in the ratio of 3:1. Now similarly, goodwill of T and company is 50,000 is also raised. T of company goodwill raised in the ratio of 2:1 because their profit sharing ratio is 2:1. So 50,000 distributed in the ratio of 2:1, 33,333 and 16,667 credited to this capital account. Now after raising goodwill notionally, the total goodwill is now how much? 1,10,000. This 1,10,000 goodwill will be written off in the books of new firm. That is the notional entry. So goodwill written off. So write off goodwill in the new profit sharing ratio, that is 3:2:1. So 1,10,000 written off in the ratio of 3:2:1. Now find out the net effect of this goodwill entries. So 45,000 credit, 55,000 debit, so 10,000 debit. So capital account of B will be debited with 10,000, goodwill debited and credited, goodwill written off. So no balance of goodwill is left to be shown in the balance sheet. Now here 33,333 credit, 15,000 credit minus this debit. So you are required to write a credit entry of 11,667. So as capital account is to be credited for 11,667. Here 16,667 credit, this is debit. So there is a debit effect of 1,667. This is the net effect to be given to the capital accounts of the partner for that goodwill adjustment entry to be recorded. B's capital account debit, T's capital account debit, to as capital account credit. This is the adjustment entry for goodwill will be recorded in the books of new firm. That's an important point to be noticed by the student. And this is what has been given to me in question number 1. Now after that I am required to prepare the journal entries in the books of purchaser. But as I have told to you, I am going to prepare all ledger accounts in the books of vendor. I am going to explain the journal entry in the books of vendor, and I will prepare a working note inevitably necessary for the purpose of recording entries in the books of purchaser. Now let me start. So books of S&N company, revaluation account, capital accounts. Now first step for the purpose of solving the sum is to write the capital balance. So capital of B and S as recorded as opening balance. Next, consider the revaluation adjustment. Building, machine and vehicles are revalued. Here you will find that machinery and building is there, vehicle is not there. So building and machinery are revalued for 50,000 and 90,000. So what is the value of building? 25,000. Revalued at 50,000. So increase in value of building is 25,000. That is required to be credited to revaluation account. And the building will appear in the balance sheet at a new value of 50,000. Next, same way, machinery 75,000. Valuation made 90,000. Increase in value of machinery 15,000. This is again credited to revaluation account. New value of machinery will appear in the balance sheet. This is how this adjustment is considered. Now next, revaluation adjustment. Provision for bad debt reserve required for S&N company. How much? 4,000. So when you make a provision for bad debt reserve, revaluation account gets debited. So revaluation account debit 4,000. Provision for bad debt reserve I write on the liability side in this fashion. This is how revaluation adjustments are considered. After considering this revaluation adjustment, next step is to close this revaluation account Find out the profit or loss on revaluation of assets and liabilities, and this profit will be distributed amongst partners in the ratio of their profit sharing. So 36,000 distributed in the ratio of 3:1. So B and S capital account is credited with revaluation profit. This is how this step is over. Now the next step, transfer reserves to the capital accounts of the partners in their profit sharing ratio. So here reserves is 25,000, that is transferred to the capital account of B and S in the ratio of 3:1. So this is how reserves account is closed and the amount is transferred to the capital accounts of the partners. After this third step is over, goodwill adjustment is to be recorded. As I told to you, goodwill adjustment will be recorded in the books of new firm. So here goodwill is not going to be raised in the books of old vendor partnership firm. So this is the entry to be recorded in the books of new firm. No entries to be recorded here. That's an important point to be noticed by the students. Now assets not sold to the new firm. We don't find in a sum that any asset which has been not sold to the new firm. So no effect. Liabilities not sold to the new firm. Suppose if the assets and liabilities are not sold to the new firm, then those assets and liabilities are required to be distributed amongst partners. Distributed amongst partners either in their capital ratio or in the profit sharing ratio. Or if any specific instruction is given for such asset, it should be the effect of those assets should be given as per instruction in priority. So no effect, all the liabilities are transferred to the new firm. Now close this capital account. I will write this balance of capital account in the balance sheet. My balance sheet total should agree. So my balance sheet total on the both the side is 3,65,000. This is how the ledger accounts are prepared in the books of vendor. Now let me explain the journal entries. See, the revaluation account is credited with 40,000. So first journal entry, building account debit 25,000, machinery account debit 15,000, to revaluation account credit 40,000. Next entry, revaluation account debit 4,000 to bad debt reserve account credit 4,000. Second entry. Third entry, revaluation profit is transferred to the capital accounts of the partner. So revaluation account debit 36,000 to B's capital account to S capital account credit 27,000 and 9,000. So 3 entries for revaluation account is done. Fourth entry, distribution of general reserve. General reserve account debit to B's capital account to S capital account 18,750 and 6,250. This is how reserve is transferred. 4 journal entries are over. Now the 5th journal entry. All these assets are transferred to the new firm. New firm is BST company. BST company is the receiver of all these assets. So BST company account debit to cash in hand account credit, to cash at bank account credit, to due from TN company account credit, due from XN company account credit, to stock account, to furniture account, to vehicle account, to machinery, to building. This is how all the assets are transferred to the new company. All these liabilities are also transferred to the new company. So liabilities account debit to new company account credit, and this capital balance is also transferred. Liabilities and bad debt reserve is transferred to the new company. So liabilities and bad debt reserve account debit to new company account credit, BST and company account credit. And similarly, this capital balances are also transferred to the new company. So here, capital of S and T account debit to new company account credit. So capital, so all these assets, liabilities and capital is transferred to the new firm. So all these accounts gets closed. This is how the ledger accounts and journal entry in the books of vendor could be recorded. I am explaining these things to you, though not asked in the question. We are asked to prepare only journal entries in the books of purchaser. But on the basis of all these details, you are required to prepare one working note, which is inevitably necessary for the purpose of recording transactions in the books of purchaser. Now, what is that working note that you need to prepare? Just look at it. I prepare here working note. You are required to prepare a working note, wherein you are required to write down the opening capital balance. Then general reserve distributed amongst partners is to be added, and then revaluation profit. Revaluation profit 40,000 minus bad debt reserve. This revaluation profit is also required to be distributed amongst partners 27,000 and 9,000. Suppose that if any asset is not taken, that is given to the partners, that is also to be recorded here. If the liability is not taken by the new firm, are also required to be distributed amongst capital accounts of the partner, that is also to be recorded in this working note. After that, you are required to find out the capital balance. So here the capital balance is being found out to be 1,65,000 and 95,250. Remember, when you prepare this balance sheet is made of only those assets and those liabilities which are transferred to the new firm. The assets and liabilities not transferred to the new firm are not found in this balance sheet. That's an important point to be noticed by the student, because it is a distinguishing point of this balance sheet as compared to the balance sheet that you have prepared after revaluation account in the admission and the retirement of a partner. So this balance sheet is made of only those assets and liabilities which are transferred to the new firm. That's an important point to be noted. So I have prepared this working note. So even though you are not required to prepare ledger accounts and journal entries in the books of vendor, you are required to prepare this working note, wherein you are required to find out the capital balance to be transferred to the new firm. This working note is inevitably required to be prepared for the purpose of straightway preparing journal entries in the books of purchaser. Next. Now I want to same way. I want to prepare the ledger accounts of the books of T and Company. First of all, I will write down the capital balance. Then I will consider the revaluation adjustments. Here the value of vehicle is valued at what price? 80,000 vehicles are valued at 1 lakh. Increase in value of vehicle credited to revaluation account. And the vehicle appears in the balance sheet at rupees 1 lakh. Bad debt reserve required, how much? 5,000. So debtors are 1 lakh. You are required to make a provision for bad debt of 5,000. For that, revaluation account is required to be debited, and this bad debt reserve appears on the liability side of the balance sheet. Revaluation adjustments are considered. Now I will close revaluation account, and the profit on revaluation will be transferred to the partner's capital account in the profit sharing ratio. So 2:1 is the ratio in which the revaluation profit 15,000 is transferred to the capital account, 10,000 and 5,000. Now distribute general reserve amongst partners. So general reserve given to in the sum 50,000, that is transferred in the ratio of 2:1. So this is how general reserve is credited to the partner's capital account. Now, goodwill adjustment not to be recorded in the books of vendor firm. You know that this goodwill adjustment is to be recorded in the books of purchaser firm, that is adjustment entered to the capital accounts of the partners. Assets not sold to the new firm not given in this sum, so don't consider. Similarly, all the liabilities are transferred, so no need to transfer any liability to the capital accounts of the partners. Now find the capital balance, write the capital balance, and prepare the balance sheet. Total. So total is 3,28,000, 3,28,000. Now, after preparing this ledger accounts in the books of vendor company, though you are not asked to prepare ledger accounts in the vendor company, I have prepared for the better understanding of the student. But for the purpose of preparing journal entries in the books of purchases, you are required to prepare one working note. And that working note, that is known as capital balance transfer to the new firm, is required to be found out. And to find out the capital balance transfer to the new firm, you are required to write the opening balance of capital accounts of the partners. Reserve distributed to the capital account is to be added. Revaluation profit is also required to be transferred to the capital accounts of the partners, that is 10,000 and 5,000. And similarly, if the assets and liabilities not sold to the new firm, if they are transferred to the capital accounts of the partner, they are also required to be considered in this working note. So this working note is important for the purpose of writing journal entries in the books of purchaser. So instead, if you are not required to prepare all these accounts, even then, if you want to write down straightway journal entries of the balance sheet in the new firm, you are required to prepare this working note. That's an important point. Now, these are the two balance sheets of S company, T company, S company, T company. These are the balance sheets made of assets and liabilities that are transferred to the new firm. That's an important point to be noticed. Now, I want to explain you one important point. See, due from X and company, 30,000. Due to X and company, 40,000. Now both the partnership firm, Amalgamate, so due from X and company and due to X and company. Both are transferred to the new firm. So, that is a mutual indebtedness. Mutual owings and claims. So, my owings towards X and company 40,000. My claim is 30,000. So, net effect 10,000 will appear in the balance sheet. Because I am purchasing the amount due from X and company, and in a new firm I am purchasing the amount due from X and company, and in a new firm I am purchasing the obligation towards X and company. So obligation towards X and company and the claim from X and company will be adjusted against each other, and the net amount will appear in the balance sheet. If the debit balance is more, then it will appear on the asset side. If the credit balance is more, it will appear on the liability side. This is how the claim from X and company, obligation towards X and company will be adjusted. That's an important point to be noticed. One more thing. Here, due to S and company, T says that I am obliged to pay S 50,000. S says that I have got a right to receive from T 50,000. That is known as mutual indebtedness. Before amalgamation, S and company has a right to receive from T and company 50,000. Before amalgamation, T and company has an obligation to pay S and company. When both the firm merges and there is a common business, their mutual claims and obligation gets offset. That's another important point to be noticed by the student. So these two are the important points to be considered before we start writing journal entries in the books of purchaser. Now let me start with the books of entries in the books of purchaser. So here I write down the entries in the books of purchaser. All these assets and liabilities and capital is taken. So let me write down the journal entry by one way. This is the working note that I have prepared for the purpose of absorption entries in the books of new firm. So first of all, cash account debit, cash in bank account debit, due from T and company account debit, stock account debit, furniture account debit, vehicles account debit, machinery account debit, building account debit. To bad debt reserve, to due to X and company 40,000 to creditors. And all this capital balance is also transferred. So to B's capital to S capital. So all the assets and liabilities are transferred to the new firm, and new firm has purchased. Debit what comes in, all assets are purchased are debited. Obligation purchased are credited. And capital transfer to the new firm is credited to the capital accounts of the partners who are going to be the partners in the new firm. This is one way to write the entry. There is another style to write the entry. Business purchase account debit 3,65,000 to S and company account credit 3,65,000. All these assets are debited. So cash account debit, bank account debit, all these assets are debited. Liabilities are credited, bad debt reserve is credited to business purchase account credit. And the vendor firm account debit to capital transfer account credit. This is another style of writing the journal entry, but I have recorded the journal entry straight for debit and credit of absorption of assets and liabilities and transfer of capital. Now, I want to write down the entries for another company. Cash account debit, bank account debit, due from X and company account debit, debtors account debit, stock account debit, furniture account debit, vehicles account debit. To bad debt reserve, to S and company, to creditors. Now transferred capital will be credited. This capital account, as capital account. So this is how entire business is transferred, and the new firm writes the entry for purchase of the entire business. This is the purchase entry that I have recorded. Now this T and company 50,000 right to receive and obligation of 50,000 S and company, that is mutual indebtedness, is to be cancelled. So these are the two separate titles. So here S and company account debit, to T and company account credit. So this mutual indebtedness is cancelled. Mutual indebtedness is cancelled because there is no obligation and no claim exists because of amalgamation of two firms. As both the firm has amalgamated, their mutual claims and mutual indebtedness get settled. And then this is the entry for settlement of mutual indebtedness is recorded. No need to write the entry for this X&N company 30,000 and X&N company 40,000 because the name of the account is same. No need to write the entry. But in balance sheet, the net amount 30,000 and 40,000, 10,000 obligation will appear in the balance sheet. Now, after writing this mutual indebtedness entry, no need to write the entry for mutual cancellation of X account because the name of the account is same in the journal entry, both the journal entries. Now, there is capital adjustment. See, this is the capital of B, this is the capital of S. Once again, S is a common partner. So, capital of S and capital of T. This is the capital balances, transfer to the new firm. Now, you are required to write down this journal entry in the books of new firm, goodwill adjusted to the capital accounts of the partner. So, B account debit, T account debit to S account credit. So, this is the capital balance. Now, partners have decided to keep the capital in the profit sharing ratio, wherein taking T's capital as the base, capital of T is to be taken as the base. And on the basis of T's capital, other partners are required to maintain their capital. If there is any excess capital or capital shortage, the excess or shortage is to be transferred to the current accounts. That's an important point. So now I want to take capital of T as the base. So, and the capital is to be maintained in the profit sharing ratio. The profit sharing ratio is 3:2:1. So let me write down profit sharing ratio 3:2:1. So for one share in profit, capital maintained is 70,000. How much capital is required to be maintained for two share in profit? That is 1,40,000. For one share in profit, capital maintained by T is 70,000. How much capital is required to be maintained for share in profit 3? So 73 is 2,10,000. So capital required to be maintained in the profit sharing ratio 70,000 into 3, 2,10,000. 70,000 into 2, 1,40,000. And 70,000 into 1, 70,000, this is the base capital. Now capital of B is 1,55,750. He wants to maintain 2,10,000. So his existing capital is short. So the amount that is short, that will be transferred to his current account. Here the S capital required, existing capital of S is 2,50,250. He is required to maintain 1,40,000. His capital is more than required. So the balance surplus capital will be transferred to his current account. So here cash brought or amount transferred to capital account 54,250 and 1,10,000. This is to be transferred to current account. Otherwise, in some of the sum, they will ask you to bring cash or withdrawn to maintain the capital in the profit sharing ratio. So this may be cash brought or cash drawn, but in this sum it is not so. You are required to transfer this amount to the current account. So now let me write down the entry for transfer to current account. Now this cash brought and cash drawn is not actually cash brought and cash drawn, but it is the amount required to be transferred to current account as you are told in the sum. So here 1,55,750 is the existing capital of B. Required capital is 2,10,000. So actually he is required to bring, but instead of bringing that amount right now, he promised to bring it future. So the amount is transferred to his current account. The journal entry for that is B's current account debit to B's capital account credit. This is how amount to be recovered from B is transferred to his current account. But here in case of S, there is an excess capital of 1,10,250 which is not paid back to him, but it is also transferred to his current account. So fixed capital account is debited and the current capital account of S is credited. This is how transfer entries are made to current account. Now after doing all these things, I want to prepare the balance sheet. See, when I want to prepare the balance sheet, here I prepare the balance sheet. So total of cash, total of bank balance, then debtors total balance. I write here bad debt reserve. I'll write on the liability side. Then comes stock. Then I total the furniture and write on the asset side. Then machinery. Then building. Then bad debt reserve I write on the liability side. Instead it can be deducted from debtors. So X and company, payable to X and company 40,000, recoverable from X and company 30,000. So net amount is the payable amount 10,000. That will appear in the liability side. After that, let me write down the creditors. So creditors are 1,18,000 are recorded here. After that, see, all these items are cancelled so that all the journal entry details are considered while preparing the balance sheet. Of course, after some time, I will remove all these cancellations. Now, vehicles. Now, capital is to be recorded, fixed capital, 2,10,000, 1,14,000 and 70,000. So this is a fixed capital recorded. Now, after recording this fixed capital, B's current account debit balance that will appear on the asset side, and C's current account credit balance 1,10,000 will appear on the liability side. Now you can have a total of this balance sheet. So total of both the sides agrees to be 1,67,250. This is how the balance sheet is prepared. So debit balance of current account appears on the asset side. Credit balance of current account appears on the liability side. This is how the balance sheet is prepared. Now after doing all these things, I want to demonstrate once again on one slide wherein all journal entries and balance sheet is presented, wherein cancellations are not made. Just observe. So these are the journal entries that we have recorded. This is the journal entry for goodwill. This is the balance sheet. This is how your answer should appear in the examination. Total is 6,67,250. This is how this sum gets solved. I have tried to explain you this sum. I feel that you have followed all these things. Thanks to all of you.